Morning, good afternoon, good evening, everyone. Is the one and only notorious glorious V, the Gorilla Economist, and I have with me today the man who needs no introduction. And if you don't know who he is by now, you've been living under a rock. He is the man, the maven of privacy, the scientist of all things security. The one and only John Jay is in the house. John, how are you, buddy?
Hey, really good, V. Thanks a lot, man. It's pretty
Hey, no problem,
creative.
brother.
Yeah.
So lots going on, my man. I guess first week we talked about credit, this, that, and the other. Second week we talked about phone privacy. This week we're going to get into banking, and this is definitely your forte. So where do you want to begin, man? I mean, people don't know how to get around, how to hide in plain sight, so to speak.
Yeah, well, I get a lot of questions about what information the banks and crypto exchanges want from people. And if you're a
Yes.
signer, you pretty much have to give up your information. But what you don't have to give up is your real relation to the asset or the property or the account funds. That's what people need
Yes.
to understand. So you have the Bank Secrecy Act and you have the KYC, know your customer, requests and things like that. It's pretty onerous at the exchanges. They want to track back where the money's coming from that you're putting into cryptos.
Right.
So we have to tell them those things, and the signer has to tell them. But what people don't realize is that the liability comes when the individual, such as yourself, if you're a signer on the account, if you own the account, the liability comes when that account gets funded. So like if you sell a coin or you sell a car or whatever property and you put money in the bank, that's
Yeah.
where you have the liability. But where you don't have the liability is where the interest in the bank account is spread out into a group. And that
Hmm.
sounds kind of weird to most people, but this is what's done in estate planning and asset protection. It's done through tools like trust organizations. It's done through what's known as unincorporated associations.
Hmm.
So if you're using a flow through or something like maybe an LLC, it could be a trust, and the owner or the trustee is more than one person, you can make it to where nobody has any liability and nobody can discover that liability until the owners claim the responsibility. So here's how this works. Let's say myself and my brother own a company, but it's an undivided interest and the company makes $1 million, but we don't claim a percentage as far as anyone else can tell. Then there's no liability to either of us. But as soon as I take some money out, whatever percent that is, I don't have to say the percent, but the amount I take out, I then have the liability for it. And I don't always have to take it out in my name to spend it.
Yeah. Yeah. That's. Can you give an example of the advantages of setting it up that way, not just for the specificities that you just mentioned, but also
Yeah,
how more broad the scope is that people could apply this to their day-to-day transactions, John?
yeah, yeah. Let's just look at it in terms of protection against creditors and or
Mm,
protection against tax liabilities, any types of collections or tax assessments. If you divide your interest or you have an undivided interest, you share your interest in property with someone else, no matter how
yeah,
much property value you have in that relationship, it's not taxable until someone else says it. And likewise, if a creditor goes to a court and gets permission from the court to attach
yeah,
the property in the group, like my brother and I, let's say my brother and I form a limited liability company, we're both the members at a bank account, and the court wants to take my interest from the company, it won't be allowed. The court cannot allow a creditor to do that. Can't happen. However,
right.
the court can issue an order allowing any disbursements made to myself, if I'm the debtor, to be levied against by the creditor. So then
Hmm.
I can choose how I want to move money around. I don't actually have to take the money. I can move it somewhere else or whatever I want to do. There's myriad of ways. So that would be a real life example.
Wow, that's powerful stuff, man. So, what do you think? What would be some of the best ways that people could set themselves up with this? And also, if you want to delve into some other things as well, because here's the thing, you know, people are like, one of the things that we always talk about is protecting data. And a lot of the banks, a lot of the crypto exchanges, you can't open up anything without a
Hmm.
KYC, AML, this, that, and the other,
Yeah,
man.
that's right. Yeah. What I recommend is, okay, when I give someone documents, I form a company, part of the documents are never disclosed to anybody. Then I have another set of documents that look like the official documents, but they're not. so that the bank will be satisfied, the exchange will be satisfied that, okay, this looks like what we're asking for, but they don't get to actually see the real documents.
Hmm.
And so what we're doing is we're owning the interest in the account through a group. We can use your family. Okay, everyone
Hmm.
has a family. I don't care if everybody in your family is deceased, you still have a family. So what we simply do is identify the owner of an LLC as a family, or we identify it two people or more, and the two people cannot be spouses, they can't be married. So it has to be two people that are not married. Then there's no divided interest until you guys claim it. You have to say so. And if the two people that own let's say an LLC, they would collectively together have to file a tax return in order to create a new liability that would have never existed. So obviously, like two brothers, they don't file jointly. Two partners in business, they don't necessarily need to file jointly. They could do a partnership or they could file themselves individually. So as long as they don't file a tax return collectively, then there's no new taxpayer that's being created. So everybody pretty much is a taxpayer. Everybody who's filing 1040s, you all have the liability. But if you move that interest over to a group of two taxpayers and that together those two individuals don't create a tax liability, then there's no tax liability, no tax assessment, no tax returns owed or due until the individual taxpayers make a claim on the money or property or whatever it is.
Very well said. John, could you explain to us exactly what these private membership organizations are, or private
Yeah.
membership associations are,
Yeah, an
the
example would be,
origins of it?
yeah.
Good.
hmm
Yeah,
Yeah, an
good.
example is what you have in common with other people. For example, if you live in a neighborhood where you have neighbors in the suburbs, everybody who has a house is a member of an association. And I'm not talking about your homeowners association. That's a different animal. And a lot of those guys incorporate, so that's a different animal. A corporation is not an association. HOAs are not necessarily associations. The association is all the homeowners because they have something in common. So a family has something in common. Someone else who's not in the family literally cannot be part of that family no matter what you say. He can't be. He wasn't born into it. He didn't give birth to the children. He's just separate. So a private membership association, the best example is a family. And you can do things as a family. You can identify the owner of a bank account holder like an LLC or a trust. You can identify the owner as your whole family. But when it comes to the bank, here's the cool thing, okay? Under the Bank Secrecy Act, if your family owns the account, the bank is precluded from doing KYC because your family is considered an unincorporated association. They don't do it.
Wow.
And I think this is the back door for all the people that, when I say people, I mean the Congress critters, those who wrote all these statutes, right? They made themselves a
Yeah.
back door because they understand how this stuff works. This antedates all our laws. This has been around for 1,000 years. The
Mm,
group is not liable until the group says it is, but the individuals could be when it comes to
correct.
civil liability. Yeah. So the PMA or family or association, the unincorporated group, unincorporated just means you did not register the existence of the group with a government agency. That's all it means. It doesn't mean it's not incorporated. It just means it's not registered with the state or a county or whatever, the feds.
Wow.
Yeah, it's really powerful. So you got the association that's unincorporated, that's not subject to KYC. Then you've got what's called gatekeepers. Gatekeepers are attorneys or organizers, or they're called organizational formation agents. Okay,
Hmm.
organizers. So if you go on the internet or you go to your Secretary of State and you form a company, a corporation, anything, whatever it is you want to form, you want to register it with the state. That thing becomes a legal entity which is subject to KYC, but your ownership interest can be in the group, in the association, and as an organizer, you're also not subject to KYC.
Oh,
So
wow.
the organizer, the unincorporated association, and then the last one is anything that's not a legal entity. So for example, if you have a trust organization that's not registered with the state, it's not a statutory trust, and it's not formed as a matter of law, it has the same status as an unincorporated association. So you just figure out who do you want to do what. So you can actually have all the privacy you want, even though they have your name and SSN as the signer, they really can
Yeah.
never discover your relationship to the property.
Hmm. So if they were trying to come after you, there's really no. Let's just say, can a group like this have any sort of weakness? Can they be audited, John?
No, it would not be subject to audit because it's not within the purview of the IRS, simply because it's not considered a taxpayer. It'd be like this. Let's say you and your neighbor, like he's out cutting his grass one day and you walk out in the driveway and you're talking to him, and then you ask him to do something for you. Like you make an agreement with him, like, hey, would you mind driving my car over to the mechanic shop since you work close by? Right? He's going to do you a favor, right?
Sure.
So you shake hands with them. Now, that's an agreement to do something. There's valuable consideration, but that is not a taxpayer. That handshake, that arrangement is not something that has to be reported. So what you want to do is create those situations where there's no presence within the IRS or taxing system. And this goes for any country, by the way. So
That's incredible.
it's an arrangement that's not in the tax system. It doesn't even need to be an offshore account. It's like you're offshore, but it doesn't exist as far as the IRS is concerned. Now, if the PMA, like if your family appointed a trustee, someone to represent the family, and that individual got a tax number and then filed a tax return in the name of the family, now you've just created a taxpayer, and now the family is subject forever to that system.
Got it. So let me ask you this, John. When somebody wants to form a PMA, we form a PMA, and now we want to go ahead and open up an account. What kind of documents would the banks ask us? What kind of questions would they probably want to probe us with? And how do we
Yeah,
get around
yeah.
that?
Okay, I have a memorandum that I included with the bank documents. And all it does is it's called a compliance memorandum. And all I did was I wrote the case law to advise the bank personnel. So that way the client doesn't have to deal with the bank personnel. He could just say, well, here are my documents. And in there, it explains. And the bank is not supposed to ask questions about the ID or existence or the articles or anything relating to the unincorporated association. They're not supposed to ask under the Bank Secrecy Act. It says it right in the statute. It's excluded. So that you don't need
Wow. Okay.
documentation. All you have to do is say, this is owned by my family in so many words, and that's what you have. You can probably open an account as your family, but then you'll have a hard time with the bankers because they're so brainwashed. They're going to say, well, it needs an EIN and all this other stuff. But
Correct.
if you get a company like a trust or partnership or an LLC, and you get a tax number for it and you open an account, they'll be so happy because you got a tax number for this thing. And all the property rights flow to your family, and they don't get to ask anything about the owner because that's your family, because they can't require everybody in your family to come in and produce ID. And who knows if anyone individual member of your family has more than 25% interest, which is the threshold. 25% interest or more requires disclosure of identifying documents.
Right.
So the PMA, it's like I said, it's an undivided interest.
John, what would be the advantages, compare and contrast? There are going to be three things that people in the privacy community look at. One is what you just mentioned, which is the PMA, which I think the majority of people have not even heard of, but
Mm-hmm.
it's very powerful. I'm
Mm-hmm.
absolutely enthralled in hearing
Mm-hmm.
this. The second thing would be an LLC set up as a pass through. The
Mm-hmm.
third thing
Yeah,
would be a trust. What
right.
would be some of the advantages and disadvantages of both, and why? And just your opinion is, what do you think will be the best route to go? And of course, it all depends on the person and the situation. But what do you see some of the advantages and disadvantages?
Well, you can push any liability you may have for taxes or any other obligations. You can push it into the group where it can never be recovered until you decide, meaning no one can ever peg you to an interest in the group and then make you pay. That's the advantage. And you could do that with a trust. You could do that with two or more members to an LLC. You can do that with a partnership with two or more members. And of course, you can do that with a PMA. I mean, all those are just as effective. And same thing with a trust. Like, for example, if I do a trust, this is the really cool thing. If we could set up a trust, we've done this many times, where we set up a
Yeah.
trust account and the trustee is the signer. So he has to give his KYC and all this stuff. But in the trust document, we make the beneficiary have 100% of all the rights over the withdrawal of funds, the right to access the money on paper. So the bank gets this document. We give them the whole document. Normally we don't. But in this case, we give them the whole document because we want the bank to know that that signer, who's the trustee, has zero rights over the funds. And if the bank pays out on any third-party creditor or claim or anything like that, the bank has to reimburse the trust with that money. So it'll never pay out. It'll never pay out. And so what we've done is change the signature rights. Okay, so the people at the bank don't understand this yet. I don't know if they'll ever figure it out. but the trustee is the signer, literally, but he has no signer rights. The signer rights are to some non-account holder that has never given his ID or never gone through KYC. We do this all the time. The banks don't see what we're doing, and they approve the trust all the time.
Oh, wow.
So we just did in Canada too for the first time. It was funny because the attorney asked the client. He said, "Who wrote this?" And the guy said, "Well, my friend did." He goes, "Wow, okay, well, like, okay, they think we can't read, you know? It's funny.
Yeah, 'cause,
They think only they can read."
exactly,
So yeah,
exactly right.
you control your signature rights and you control the liability.
That's incredible, man. I think,
Mhm.
you know what? I mean, personally speaking, this is something that I would definitely be doing, especially with all the. I mean, even as a business, this is a great idea.
Oh yeah, oh
Like
absolutely. And
if
businesses
you're
do
running a
that.
business to it. Yeah.
Yeah, the business does do that. The thing is, if you look at a standard business charter, the liabilities are already established in what's called capital accounts, and also in what's done known as accounting practices. So like, for example, I was reading a standard partnership agreement that is used in Canada, and this is done here in the States too, or anywhere. If accountants write these and if attorneys write these relationships, what they always do is identify every interest in the contract. So you can't hide. You can't have an undivided interest. If you just rely on your attorney or accountant, you're never going to get the real protection that you can have. But if you
Mm,
rewrite it and you make, like, for example, instead of a partnership that has two capital accounts, you can make an undivided interest in one capital account, and there you go. Now you have an association with an undivided interest. And I didn't call it an association. It's just two partners that have an association, happen to be partners with an undivided interest. So there's no liability until there's a disbursement of funds.
got it.
You can do it many ways.
Wow.
But yeah, so the path is right there. If you just read the statute and look at the notes, and you can look at the regulations really tell you a lot of details. So what you'd want to do is look up on the internet the Bank Secrecy Act. You can,
Hmm.
okay, now this is for the United States. I imagine you can do something similar in the UK, Canada,
Of
wherever else.
course. Any
Yeah,
one of these Commonwealth countries.
yeah. And then what's really telling is the regulation that's written by the agency in regard to the statute. So the statute is the Bank Secrecy Act. The regulation is what tells you all the details. And then if you look further in the bottom, you'll see case notes, and you can look up the case law, and then you'll learn how this works.
Interesting. Very interesting. John, let me ask you this. So you said that there's no liabilities there until there's disbursement.
Mm-hmm.
Technically and legally speaking, for the lay person that's out there, what is that disbursement? What does that mean? What does it entail? What does that look like?
A paycheck.
Got it.
That's a
Okay,
great
perfect.
example. Just a paycheck, or what, someone sends you money, somebody taking money out of the LLC or the trust or putting it in your personal account. So let's say, for example, here's how you would avoid that. Let's say I have a partnership and I'm due some money. Let's just say hypothetically it's $1 million. Well, I don't need $1 million. I might need $50,000, for the year or something. So I'm going to take my $1 million, and instead of me taking the money, I'm going to wrap it up in an escrow contract. I'm going to have my partnership send the money into escrow. So now it goes from the partnership where I don't have an interest yet, and it goes into an escrow account, which is a trust. And on the other side of that escrow is a real estate closing date. And that escrow agent will disperse the funds to acquire property that maybe it's something I want to buy, but I don't have to
Hmm,
take the title to it. So I can move the money from my partnership over to an asset titled in some company or trust, another company, and I can manage that asset and still not have received a gain, and still not be subject to a third party levy or creditor, attachment.
remarkable. That's incredible. So, John, let me ask you last but not least, if people want to find out more information about this, how do they go about contacting you? How do they go about getting into this program?
Well, they want to look at PrivacyFightClub.com.
Perfect.
Then they can start seeing what kind of information we have. There's some videos and content, and they can ask me directly. I mean, there's ways to schedule calls, and I could explain things. We have a lot of articles too that we're just publishing now. So yeah, we want to provide, like, I like to provide a lot of reference material. So if you go to that website,
Yeah.
you'll be able to get that. Do some research. Talk to your people, your accountant. I talked to an Australian accountant the other day. I don't know why people
Hmm.
want me to talk to their accountant. So she's telling me, wow, that's a really good idea. I understand about diminishing the value because we were doing some sort of accounting thing. And then she
Yeah.
said, but explain to me again, like we were just talking about, how does how does my client get out of a tax situation? Let's say she has a $500,000 and then her cryptos, for example, are worth now $700,000, and she'd have to claim that $200,000 gain on her tax report. And I said, sure, if she realized the gain. And so the accountant kind of got stumbled a second, and she said, well, okay, but she is going to get that money. And I said, yeah, but not at that moment. And so I didn't go further because I didn't want to tell her everything. But the whole idea is that you have a gain somewhere out here that you haven't yet realized it in your name. The gain's out there. It's a gain, but not legally. I can move that gain somewhere else. I can borrow it out. I can move it through escrow. I can spend it. As long as it doesn't end up in my name, I can move it around and not have a tax consequence or be subject to the liabilities from a creditor. So that's what you want to look at. But yeah, if you look at the PrivacyFightClub.com, it's all there.
Brilliant. Absolutely brilliant. John, thank you so much, man. You are an absolute genius when it comes to dealing with this, and I want to thank you. Now, folks, you heard it here first. Go to PrivacyFightClub.com. Go there, schedule your call with John. Let him tell you exactly what it's all about. Let him walk you through it, and go ahead and start reclaiming ownership of your life. You know, that's the John, I'd have to say that's the crux of the Privacy Fight Club. It's not just about privacy. It's about reclaiming ownership of who you are, your personhood.
Yeah, it is not wrong to hide your money, and you should hide the rights you have over the property and money that you're using that benefits your life. You should hide.
Absolutely.
It's not illegal to do that.
Absolutely. Very well said. Folks, thank you so much for listening in. Again, go to PrivacyFightClub.com and check out the links that are there, and let's schedule a call today. And with that being said, this is the Gorilla. We are over and out. Take it away, Kung Fu.